If you are somewhere past 65 or headed there soon, I want you to sit with me for a few minutes because I'm going to show you something that took me years to figure out on my own, and I am a little frustrated that nobody ever laid it out plainly before I did. There are 3 institutions that are quietly collecting money from you right now that the law says you stopped owing. Not a discount on what you owe, not a partial credit, the full amount. Gone from your account month after month, year after year for one quiet reason. None of them have any real incentive to walk up to you and explain where the door is. The IRS processes 150 million returns a year. Your bank has a few million customers. Your county clerk's office mails out property tax bills to everyone in the county without stopping to check whether you stopped owing the full amount the year you turned 65. They are not villains. They are just enormous and indifferent. And indifference, when it is attached to a monthly fee or a tax bill or a property assessment, costs you real money over a long retirement. By the end of this video, I am going to walk you through 3 dangers, 3 specific ways these institutions are collecting from you past the point the law says they are allowed to. And then I am going to give you 5 solutions, 5 clean, simple moves that stop the bleeding without putting a single dollar of what you have built at any risk. I am not selling anything here. I am not going to make you afraid. I am a retired person sitting at a kitchen table who spent the better part of 2 years figuring this out the hard way and decided there was no reason everyone else had to do the same. Everything I am going to tell you is grounded in real federal law, real state programs with real names and real numbers you can look up today on government websites that are free and public. If I say something that turns out to be wrong for your specific situation, correct me. That is what the comments are for. Let me earn your trust by being careful with the facts, and let me show you where the money is sitting so you can go quietly collect it. Here is the first danger, and it surprises almost every person I have sat down with to talk through this. The IRS is still collecting taxes from you that you legally stopped owing the year you turned 65. And it is doing it because you never told it to stop. I want to be precise about this because the phrase sounds dramatic and the reality is actually much calmer than it sounds. This is not about anything illegal. This is not about the IRS making a mistake. This is about legal deductions and exemptions written right into the federal tax code specifically for people in your age group that only work if someone checks the right boxes on the return and that the IRS will not check for you. The mechanism is straightforward. When you file a federal income tax return, the IRS allows you to lower your taxable income in several ways before it calculates what you owe. The most common is the standard deduction, which is a flat dollar amount subtracted from your income before the tax rate is ever applied. In 2026, the standard deduction for a married couple filing jointly is $30,000. For a single filer, it is $15,000. Those numbers are the same regardless of your age, but the moment you turn 65, an additional amount is added on top. In 2026, that age-based add-on is $2,050 per qualifying person. For a married couple where both spouses are 65 or older, that is $4,100 of additional income shielded from federal tax before a single dollar of the rate is ever applied. And sitting right on top of that, for the first time starting with the 2025 tax year, there is a brand new layer that most people have never heard of. It is called the Senior Bonus Deduction, and it was created by a federal law passed in 2025 and confirmed by the IRS in its own published guidance in February of 2026. It is worth $6,000 for a single filer who is 65 or older and $12,000 for a married couple where both spouses qualify. That is not a replacement for the standard deduction. That is $12,000 additional dollars sitting on top of everything else. For a married couple in their late 60s with a modest combined income, stacking all 3 layers together can bring their federal income tax liability to 0. Not a smaller bill than they expected. 0. And most of them are still paying a tax bill every April because nobody ever showed them where those boxes were on the form. There is a third tax break in this same category that almost no retiree ever uses, and I want to mention it because for people managing serious health costs, it can be more valuable than either of the deductions I just described. The IRS allows you to deduct medical expenses that exceed 7.5% of your adjusted gross income. Adjusted gross income is the total income number on your return before the standard deduction is subtracted. Most people hear that and immediately assume their medical costs are too small to matter. They do the math in their head, get a rough number, decide it is not worth the paperwork, and move on. The mistake is doing that math loosely because what counts as a deductible medical expense is broader than most people realize. Medicare Part B premiums count. Medicare Part D premiums count. Supplemental insurance premiums count. Prescription copays count. Dental work counts. Hearing aids and eyeglasses count. Transportation costs to and from medical appointments count. A portion of long-term care insurance premiums counts depending on your age. For a typical retired couple managing 2 sets of Medicare cost, supplemental coverage, prescription expenses, and 1 or 2 significant dental or hearing items in a year, the total very often crosses the 7.5% threshold. Every dollar above that line is a dollar the IRS is not legally entitled to include in your taxable income. And if you have been taking the standard deduction for years without ever adding up your actual medical costs to see whether itemizing would produce a larger deduction, that comparison is worth making before this tax season closes. Here is the anchor I want you to hold. Pull out your most recent federal tax return, Form 1040 or version Form 1040-SR, and look at the deduction section. There should be a line that shows an additional amount above your standard deduction for being 65 or older. And for returns covering the 2025 tax year or later, there should be a separate $6,000 senior bonus deduction on top of that. If those lines are blank and you are 65 or older and your income is under $75,000 as a single filer or $150,000 as a married couple, your return may be missing deductions you were entitled to claim. The fix is not complicated. Talk to a tax preparer, preferably one who works regularly with retirees, and ask them directly, were my full age-based deductions applied to my return, including the new senior bonus deduction from the 2025 law? If you file your own return, the software will walk you there if you enter your age and do not rush past the section. And if you filed for 2025 and missed it, the IRS gives you 3 years from your original filing date to file an amended return on Form 1040-X and recover the difference. Do not just do nothing about this. The boxes exist for a reason. They are there because the law decided you stopped owing that portion of your tax bill. All you have to do is claim what is already yours. There is also a quieter version of this same tax problem that catches people who set up withholding on their Social Security check years ago and never revisited it. When you first enrolled in Social Security, you may have filled out a form called a W-4V and asked the government to hold back 10 or 12% of your monthly benefit for federal taxes, just to be safe. That felt responsible at the time, and it probably was. But that withholding has been running ever since, month after month, based on a tax picture that may have changed dramatically. If your actual tax liability after all the correct deductions is now 0 or close to it, you are sending the government a monthly prepayment on a bill that does not exist and waiting until April to get it back as a refund. That is not a tax being paid on time. That is your own money being held by the Treasury for 12 months interest-free before it comes back to you. Filing a new W-4V to reduce or eliminate that withholding puts the money back in your Social Security deposit immediately and keeps it there every month. One form, free to download from irs.gov, worth potentially hundreds of dollars a year back in your monthly check. One more thing belongs in this tax section because it involves money sitting inside your retirement accounts that you may be pulling out earlier than you are required to and paying income tax on without realizing the rules changed underneath you. The age at which the IRS requires you to start taking money out of a traditional IRA or 401k, called the required minimum distribution age, is now 73, not 70, not 70 and a half, which was the standard for many years. 73, and it is scheduled to rise to 75 for people born in 1960 or later under the Secure Act 2.0. For someone who turns 65 this year, that means 8 years between now and the first year the IRS can require a distribution from your retirement account. 8 years of your money continuing to grow inside the tax-deferred shelter of the account, untouched and unshrunken by a mandatory withdrawal you do not yet owe. If you have been taking distributions from your IRA or 401k before age 73, that is your right, and there may be good reasons to do it. But if you were doing it partly because you believed the law required it, and it does not require it yet for your age, it is worth revisiting the calculation this year. Every dollar you pull out early is a dollar you pay ordinary income tax on now, a dollar that leaves the tax-deferred shelter permanently, and a dollar that can no longer compound inside the account for the years between now and when you actually need it. The anchor here is simple. Look up your birthday against the current required minimum distribution age chart on irs.gov. If you are under 73, you are not required to take anything this year. Whether you do or not is a financial planning decision, not a legal obligation. And knowing the difference can save you real money on your tax bill. Now here is the second danger, and this one is sneaky in a specific way because the amounts are small enough that most people never think to question them. Your bank is charging you a monthly maintenance fee that it was supposed to stop charging the year you turned 65, and it has absolutely no reason to tell you that. The mechanism is the same at almost every big retail bank in the country. Walk into a Chase branch, a Bank of America branch, a Wells Fargo branch, or any of the large regional banks like PNC, TD Bank, US Bank, Regions, or Fifth Third, and you will find a standard checking account that costs somewhere between $10 and $15 a month just for the right to keep your money there. That is $120 to $180 a year posted to your statement in small print, month after month with no red flag next to it. The bank calls it a service fee. It puts it in fine print. It never sends you a letter saying the fee has been applied again this month. And here is how to stop it. It just collects. Here is the part the teller will not mention when you walk in. Buried in the same bank's own account agreement, usually in a section nobody reads, is a clause that waives that fee entirely for account holders who are 62 or 65 or older, depending on the institution. Some banks waive it for any senior with no minimum balance required. Some waive it for seniors who have direct deposit of their Social Security or pension. Some will waive it simply because you asked. The conditions are usually minor, but the bank will not print them on a poster in the lobby, and the person who opens your account will not bring them up unless you ask specifically. Here is the anchor I want you to hold. Call the number on the back of your debit card this week, or walk into the branch and say these exact words. I am over 65. Do I qualify for a senior fee waiver on my account? The person on the other end of that call has the form. They waive this fee regularly. They are simply waiting for you to ask. If your bank says it does not offer a senior waiver at all, that is worth knowing too, because there are banks that do, and a simple account transfer moves your money and your direct deposit in a few business days without disrupting anything. Do not just do nothing about this. $180 a year sounds small, but over a 20-year retirement, that is $3,600 that left your account one quiet month at a time for a fee that was supposed to stop the year you turned 65. That is real money, and it belongs to you. And while we are talking about your bank, I want to mention something else that catches seniors off guard, because I have seen it happen to people who thought they were doing everything right. If you are carrying an annual fee on a credit card, the same principle applies. The retention department at most major card issuers has internal authorization to waive that fee, apply a statement credit, or move you to a no-fee version of the same card without closing your account or affecting your credit history. They do not advertise this. They will not call you before the fee posts, but if you call the number on the back of the card and say you are considering closing the account because of the annual fee, and then you stop talking and wait, the offer very often comes. The silence after that sentence is where the money is. Here is the third danger, and this one arrives in your mailbox once or twice a year in an envelope you have probably been opening and paying without ever questioning the number inside. Your county is mailing you a property tax bill for the full assessed amount when there is a senior exemption sitting unused on the shelf, an exemption that belongs to you that nobody in the clerk's office is going to call you to explain. The mechanism is the same in nearly every state in the country. Almost every state offers some form of property tax relief, specifically for homeowners who are 65 or older. Some states freeze the taxable assessed value of your home the year you qualify. Your home can keep rising in market value. The houses around you can sell for twice what they sold for 5 years ago. Your bill stays where it was the year you filed the application. Other states take a flat dollar amount off the assessed value before the tax rate is applied. Some offer income-based rebates that send an actual check back to you at the end of the year. A few allow seniors to defer the entire property tax bill until the home is sold, treating it as a quiet lien against the property that does not come due until then. In Texas, the school district tax portion of your property bill is frozen the year you turn 65, with no income test at all. Your age is the only qualification. In Florida, the homestead exemption of $50,000 stacks with an additional senior exemption of up to $50,000 more in counties that offer it. In Pennsylvania, the Senior Real Estate Tax Rebate Program can return up to $1,000 a year to qualifying homeowners and renters. In New York, the Enhanced Star Program reduces the taxable value of a senior's home by tens of thousands of dollars each year. In New Jersey, a combined program launched in 2026 merges the Senior Freeze and the Anchor benefit into a single application that dramatically simplifies the process. Every one of these is a real program with real money attached to it. Here is the anchor I want you to hold. Search your state's name and the words Senior Property Tax Exemption. The first result is almost always the official state website. Read what it says about the income limits, the age requirements, and the application deadline, which in most states falls early in the calendar year. Then call your county assessor's office, not the tax collector, the assessor, and ask 2 questions. Do you have a senior property tax exemption? And what is the deadline to apply? The clerk on the other end of that call processes this paperwork regularly. They have the form ready. They are waiting for you to ask. In many counties, you can also apply retroactively for 1 or 2 prior years if you miss the window, which means every year you wait is not just a year of savings lost going forward. It may be a year you cannot recover at all. Do not just do nothing about this. The bill in your mailbox is real and the exemption is equally real. The only thing standing between you and a smaller bill every year for the rest of the time you live in that home is 1 phone call and 1 form. So now you understand the 3 dangers. The IRS collecting past the point the law required. The bank quietly billing a fee that was supposed to stop. The county mailing the full property tax when an exemption has been sitting unclaimed since your 65th birthday. The pattern is the same in all 3 cases. Large institutions with very small incentive to point out the door, billing you for things you no longer owe, and waiting for you to either never ask or give up before you do. Now, let me give you the 5 solutions. 5 specific moves that stop each drain and put your money where it earns something instead of sitting quietly and shrinking. Solution number 1 is the one that costs nothing and pays immediately. Claim every tax deduction and exemption you are entitled to before you sign your next return. That means the standard deduction for your filing status, plus the age-based add-on of $2,050 per qualifying person, plus the new $6,000 senior bonus deduction if you are filing for tax year 2025 or later and your income is under the threshold. Stack all 3. If your return does not show all 3 layers, it is not complete. Ask your preparer specifically. Look at the return before you sign it. And if you filed a return in the past 3 years that was missing any of these, Form 1040-X gets you back in and recovers the difference. 1 form, a few weeks of processing, and the refund arrives. Real money for the price of a few hours and a stamp. Solution number 2 is the bank call. Call the number on the back of your debit card this week and ask specifically about senior fee waivers. Write the words down before you call if it helps. I am over 65. Do I qualify for a senior fee waiver? If the answer is yes, the fee stops. If the answer is no, ask what it would take to waive it and whether a different account type for seniors is available. If the bank genuinely has nothing, you now know to look at institutions that do, and there are several that actively court senior account holders with no-fee accounts and direct deposit perks. Either way, you have done in 10 minutes what the bank has been quietly hoping you would never do. Solution number 3 is the property tax call. Call your county assessor this week and ask the 2 questions. Do you have a senior property tax exemption, and what is the deadline to apply? If the exemption is available and you have not applied, ask for the form right then. Many offices will mail it, email it, or let you pick it up at the counter. Complete it, return it before the deadline, and starting with your next bill, the exemption quietly reduces what the county is allowed to charge you. That saving repeats every year for as long as you own the home. In a fast appreciating market, the value of a frozen assessment compounds over time in ways that can amount to tens of thousands of dollars over a long retirement. Solution number 4 is moving the cash that is sitting above 3 to 6 months of living expenses out of a checking account that pays essentially nothing and into a high-yield savings account at an institution that is paying real interest. The best online banks right now are offering somewhere around 4% to 4.5% annual interest on savings accounts that are federally insured by the FDIC up to $250,000 per depositor. On $20,000 parked in one of these accounts, that is $800 a year flowing back to you in monthly deposits on money that is still completely accessible within a business day or two when you need it. The honest trade-off is that you do everything online or through an app, and there is no branch to walk into. Transfers to your regular checking account take a day or two. This is not where you keep next week's grocery money. This is where you keep the money you will not need for 90 days or more, and that is currently earning a fraction of what it could be. Solution number 5 involves the money you are confident you will not need for at least a year. Treasury bills, purchased directly from the United States government through the free website Treasury Direct at treasurydirect.gov, are short-term loans you make to the federal government in exchange for interest paid at maturity. The United States has never missed a payment on a Treasury bill in the history of the program. Right now, Treasury bills are paying somewhere around 4 to 4.5% depending on the term, and there is a tax benefit most people never hear about. The interest on Treasury bills is exempt from state and local income tax. Federal tax still applies, but if you live in a state with its own income tax, which most states are, that exemption can be worth an additional 1 to 3% of your effective yield compared to keeping the same money in a bank savings account where state tax applies to the interest. On $50,000, the difference is real money every year. The honest trade-off is that Treasury bills come in fixed terms: 4 weeks, 13 weeks, 26 weeks, 52 weeks, and if you need the money before the term ends, you have to sell on the open market where the price can move. So this is for money you are genuinely comfortable leaving in place for the full term. But for that money, the combination of a competitive yield and a state tax benefit makes it one of the most efficient places a retiree can park cash that does not need to be liquid immediately. Let me tie all of this together because there is a single thread running through every danger and every solution, and I want you to see it clearly before we close. The 3 institutions we talked about, the IRS, your bank, and your county clerk, are not your enemies. None of them woke up this morning thinking about how to take money from people over 65. They are simply very large, very busy, and organized around a system that only adjusts when you ask it to. The IRS will not check the senior boxes for you. The bank will not waive the fee until you request it. The county will not apply the exemption until you file the form. And the cash sitting in your checking account earning less than 1% will not move itself to where it earns 4%. Every one of the 5 solutions I walked you through today requires only that you ask the question, or fill out the form, or make the call. Not one of them involves risk. Not one of them requires hiring anyone. Not one of them takes more than a phone call or a short form to start. What they require is knowing that the door exists, which you now do, and deciding it is worth the few minutes it takes to walk through it. The money has not gone anywhere. The deductions are still on the form. The fee waiver is still in the account agreement. The exemption is still at the clerk's office. The high-yield account is still paying 4%. The Treasury bill is still backed by the full faith and credit of the United States government. None of it expired. It has just been waiting for you. I want to say something before we close because you may have noticed that the 5 solutions I walked you through are not all directly about the three dangers I opened with. Two of them are the tax fixes and the bank call and the county call, but the other two, the high-yield savings account and the treasury bills, are about something slightly different. They are about what happens after you stop the leaks, because stopping a monthly fee or claiming a deduction puts money back into your account. And the question that immediately follows is where that money should sit while it waits to be used. Most retirees, through no fault of their own, have that money sitting in a checking account at a large retail bank, earning less than half of 1%, while inflation runs around 3% a year. That gap, the difference between what the money earns and what inflation takes, is a slow and invisible drain that is as real as any fee or missed deduction. It is just quieter. The 5 solutions together address both the visible drains and the invisible one. They stop the money from leaving through the 3 channels we talked about, and they move what remains into places where it earns something real, instead of sitting still while its purchasing power softens year by year. That is what I mean when I say this is not about getting rich, or chasing yield, or taking on risk. It is about removing the drains that were already there and giving the money that remains a place to rest that is more dignified than the bottom of a checking account. Let me ask one small favor before you close this out. This video is not really for you. Or it is for you, but it is also for someone you know. Think of one person you love who is over 60, who worked carefully their whole life, who keeps most of their money in one checking account at one bank, and has been paying every bill that arrives without ever once questioning whether the rules changed. Maybe it is your brother. Maybe it is a neighbor who still brings in the mail by hand every afternoon. Maybe it is your mother who has been living on a fixed income for 10 years and has never heard the words senior property tax exemption spoken out loud in her direction. Pick that one person. Sit down with them this week. Show them this video. Or better yet, sit next to them and read through what you learned together. You will be doing for them what I wish someone had done for me at 65. They will save real money. They will not make a big deal of it, but you will see something settle on their face when the information lands and they realize the door was there the whole time. Take care of that money. It earned its rest. I will see you in the next one.